And I'm working more today on my stock market project. I don't have too much time this morning, so I'm going to be brief in my overview. But I'm going to start by going over the project, what my goals are, what the structure is. Then I'll talk about quickly what I've done so far, and then I'll talk about what I'm going to be doing today. So I have two goals for the model. First goal is beat the S&P 500 by a significant margin while remaining market neutral. So the S&P goes up on average 6% per year. I want to do substantially better than that, 3 to 4 times that, and go up 18 to 24% per year. And I want to stay market neutral. So the strategy should be immune to bull markets, bear markets. It should generate steady returns regardless of what the market's doing as a whole. Now, I'm starting with the stock universe, so I have data going back to 2011. You don't want to use all data. You need to trim down basically your data set to things that are similar and things that are high volume. Similar so that there are similar characteristics to train things. For example, common stocks like Apple and Tesla just move differently from ETFs. So you don't want to train those two types of assets together. Now, the other thing is volume. So you want high volume, one, because there's less slippage, there's less spread between the bid and ask price. But also that makes it more scalable. So if I'm able to get a really good strategy that reliably returns a really high Sharpe ratio, this is going to be sellable to quant shops, hedge funds, stuff like that. So to get people to invest, you need the model to be scalable and you need it to work on high volume stocks only. So that was the first step. That's really easy. I wrote some code for that. I have several different universes. I found a really good one. Now the returns model. This should be predicting. This is the workhorse of the whole strategy. Is the machine learning model that's here. So it's a light gradient boosting method. It should be predicting things like returns relative to market or sector, probability of a positive return, Sharpe ratio, something like that. And I've found good success using the Sharpe ratio. So I've got a good model. I got that about a month ago. The final step, once I have the model, is incorporating a portfolio. So I've found some interesting things. I'll talk about that in a second. So what's the model and why do I think it's good? So after a little over a month iterating on models, I stumbled on this one. So first off, here's why I think it's good. So if you look at the red box, these are the metrics I'm interested in. Top metric, information coefficient, is telling me about the predictive power of the model. The stock market has a notoriously low signal to noise ratio, so my goal is 0.01 to 0.02. Here I'm getting 0.047, well above my goal. These next four metrics are telling me about the stability of the model, so you want something that's really powerful in predicting, but you still want it to be stable. So you don't want something that's really powerful when it's right, but really wrong when it's wrong. So that's what these stability metrics are telling us. The standard deviation of the information coefficient should be 3 to 13 times the information coefficient. And you see here it's 3, so at the lower end of the range, it's standard deviation, so the lower the better. Information coefficient to information ratio on a daily basis is 0.3. My goal is 0.03, so it's larger by an order of magnitude. Also on an annual basis, my goal is 0.3 and I'm getting 2.2, again larger by about an order of magnitude. In the T statistic, my goal is 1.98. I'm getting about 2 times that. So the first reason this looks good is because it's hitting all my metrics. Now this is for a single model trained from 2011 through 2019, validated from 2019 through 2022, and tested from mid-23 through the beginning of 26. So not only do the metrics look good, the decile analysis looks really good. So this is the hallmark of a perfect decile analysis. The bottom decile, bottom 10% should be the worst performing. Top decile, top 10% should be the best performing. And it should be monotonically increasing in between, which just means that each decile is higher than the previous decile. And that's exactly what we see here. So the final reason I'm confident in this model is I did a walk forward analysis. And I looked at every year. Instead of just doing a single model, I trained a new model for every year from 2016 through 2025. And you see the information coefficient is above my threshold every year. It's actually above the upper threshold of 0.02 every year except one. And the information coefficient to information ratio never falls below about 0.7 or so. So it works well on the metrics. The decile analysis looks perfect, and the walk forward analysis looks good. So I'm confident in this model. Now, I tried implementing some portfolio strategies on this model, and I found that with the single model going from 2023 onwards, it was really easy to get a good strategy. So basically, anything I tried gave me good returns, a good Sharpe ratio, everything. This was not the case when I used the full walk forward results. So when I went from 2016, it basically lost money from 2016 till the beginning of 2022, and then basically flatlined until mid 23, and then took off just like the other model did. So the problem I'm having here is it does really well since mid 2023, but basically fails before that. So I tried optimizing to some of the early years. I said, okay, let me optimize this strategy to the time period from the beginning of 2016 to the middle of 2018, and let's see how that does. And let me find the results. Where did I put that? Here we go. So you see beginning of 16 to mid 2018, it's doing really well, but afterwards it fails. So this is kind of the inverse of the problem I'm having here. And we could summarize the problems with the portfolio strategy on this model as if it does well at late times, it does poorly on early times. If it does well on early times, it does poorly on later times. So, what is the reason for this? There could be a couple of reasons I've determined. One is market dispersion. So the market became significantly more dispersed in 2020. There are two reasons for this. One, the rate of new stocks being added to the market increased dramatically in 2020. So there are just more stocks in the market. And the second reason is the participation of retail traders. So there are way more retail traders flooded into the market in 2020, driven primarily by the pandemic and by stimulus checks. So that could be the reason as well. The other macro regime thing that's going on during this time is interest rates. So interest rates, as everyone knows, were basically zero during the 2010s up until 2022 when they became non-negligible again. So I think the reason that this does well on early times but poorly on later times, or well on later times and poorly on earlier times, is because of one or both of these regime changes that happened around 2020. So I basically was looking into why does this portfolio strategy not perform well, and I looked at each decile analysis from the walk forward models, and you see that even though that one I showed earlier looked perfect, this one does not look perfect. So some of these look perfect, but they're not all monotonically increasing, and the spread is changing a lot. So you see here in 2020, there's about a 0.08 spread from minus 0.06 to 0.02. So 8% spread. In 2021, it's from minus 0.2 to positive 0.15, so 35% spread. So 2020, 8% spread. 2021, 35% spread. So not all the decile analyses look perfect, and the spread is changing quite a bit. So the next thing I did was look at the model. What if I go through and drop out every feature that has a coefficient of variation above 1 and a mean importance below 0.05? And these are the results here. And this decile analysis actually looks better than the previous one. And if I look at the returns when I implement a simple portfolio strategy, you see now it does well from 2016 through the beginning part of 2020. Then it fails 2020 to the beginning of 2021, and then it turns it back around again. So the problems changed from these two different regimes, early regime and later regime, where I can only do well on one and I do poorly on the other. Now it does well over the early regime and the later regime, with the exception of COVID. So it's failing during COVID. And something interesting that I found is it doesn't fail during the COVID crash. It actually spikes up during the COVID crash. I think from the short half of my long short strategy. And then it fails during the rally afterwards, which is commonly known as the trash rally. So uh, I found a nice piece of music. It's called Pantheon by Heron Valet. Okay. Good intel. Let me pull it up. When regime change happened, Donald Trump caused a huge sheet. You mean when the stock market changed regime, or with him trying to do regime change in Iran or Venezuela? Neither one was really successful, was it? Okay, let me pull that up. I like this song. Good choice so far. Um, yeah, so basically, I got that new problem, which was good. So the next thing, I basically was looking around at models. I decided to do a bunch of different models, a bunch of different models and portfolio strategies because I wasn't able to find a unified one that does well. So I want to test them all over the paper trading time. Um, and I found a couple of days ago that actually, if I use 6 months of validation data, it's performing well. Previously, I found here, I decided to use more validation data because I decided that if I use 3 years, it's not significantly worse than 1 year. So more validation data, the better, I figured. But I don't think this is the case because there's basically a trade off between the validation and test training sets. So um, basically, the more validation, you want as much validation data as possible, you want as much test data as possible. But when you use more validation data, it comes at the cost of test data. So more validation data, less test data, more test data, less validation data. So they have a trade-off. And the test data, actually, you want it to be as recent as possible, but you still need some validation time to tune the hyperparameters. So that's what I'm doing here. I just gave it 6 months of validation time. And actually, this is clearly the best of the three: 1 year, 3 years, or 6 months. 6 months clearly performs the best. So then yesterday, I went ahead and did another walk forward analysis on the same model using only 6 months of validation time. And it seems like it's performing better, I think. If you look at these magnitudes, so we don't get the spike in 2021, but this also looks a lot more stable, and like the early years look better. So, um, and oh yeah, also the information coefficient to information ratio, the lowest it goes is just below 1 here. The lowest it goes here is like also a little bit below 1. So basically, the problem here is this isn't comparing apples to apples. This is from the second half of 2016 and the first half, sorry, second half of 2015 and first half of 2016, and that's how each one's structured. So uh, whatever the year is here, half of the data is shared by one model, half the data is shared by another model. So I really need to compare apples to apples. Um, and that's what so I need to change the walk forward analysis, but I'm having trouble getting that to work. Um, so I'm hoping I can do that this morning. And then the next step will be change the portfolio class so that it can take in a walk forward analysis with 6 months of validation data. Min train months 22 is what I did here. So here's the decile analysis. So I don't want this one. So the first fold went from 2011 1-1 to 2015 1-1, 2015 1-1 to 2015 7-1, So why do we still have 4 years of trade data? Never thought I'd hear myself say, y'all go ahead, I think I'm gonna kick it with my girl today. I used to be commander-in-chief of my pimp shit flying high. Want me out the sky. But I know it feels so damn good. Said if I could go back and make it happen faster. Baby, if I could, Miss Independent to the fullest. She helping me pull it. She shot the bullet. Hey, Krishna. How are you? I'm good, thanks. Another good day. I'm happy to be living. Can jointly fly off into NASA. Who seemed to only dig the head of football teams, and I was the class clown that always kept your laughter. We were never meant to be, baby, we just happened. So please don't mess up the trick. Hey, young world, I'm the new slick Rick. They say I move too quick, but we can let this moment pass us right into ashes. Let me blow the ash right before my classes. Full advice, OMG, you listen to that, bitch. Oh, yeah, that was really good. Give me more recommendations. I like classical music. This is bad, real bad. Michael Jackson, Joe Jackson, usually your boyfriend now. I'ma ask him. I don't know if 22 is gonna be good. I don't need to make the same mistakes I did. Don't wanna fall back on my face again. Okay, this is taking a while, but I need to figure out how to get the data. Dynasty by Adrian Berenguer. Good. Dynasty. So 2013 5-1. So we need to move it up ahead 7. So let's use 29 training months and see how that does. Okay, let's see how that split is. Validating from June 1 to 12/1. So we need one more year or one more month of training data. No, I haven't talked to him yet. I'll ask him when I talk to him, though. Hey, Sir Night Night. Hey, LLM and Son. The large language model's back. How hard is it to get a government job where you live? I don't know. I really don't want one. Yeah, my Indian friends say that government jobs are like the premium, right? Like they say the most respect people will give you is if you get a government job. They say if you go to the USA and get fired and come back, you're not respected. Um, the strategy is to crack some exam, get a stable job, and do side business. I guess that's a fine strategy. I have my dad's cousin, my second cousin, is my dad's cousin. She works for the federal government, and she always says to me, "You want to get a federal government job because you can't get fired, and you make good money. You don't make the most money, but you can make good money over your life, and you'll never be fired." So she always tells me that's what I should do. But I just really don't want a government job. The problem with government jobs, I don't know how it is in India. I'm assuming it's the same. Um, you could easily spend your career on something that's not meaningful, which sounds like a nightmare to me. So we have up through 21, 22, 23, 24, 25. They're not so premium in terms of money. My dad was a government employee all his life, but it's not for me. It gives good, stable income, but doesn't pay well. I work in a private job, but it's similar to a government job. I won't get fired if my work is shit. Yeah, that sounds like a government job to me. Yeah, I mean, that's true. I could hypothetically do that, but that's not true until I have a strategy that works. And really, I have one life. I don't want to spend it working for the government. I don't like governments. I think governments are inefficient. Um, Good. Now this is working correctly. We'll get an extra year even out of this. Or you have to aim for HFTs. High frequency trading? Is that what you mean, HFT? High frequency trading or something else? Okay, so let's look more at this. Okay, so 2015 looks excellent. I can't always quit my job. I mean, I don't really want to, though. I like my job. I have a good job. It makes no money, but it's very interesting and very useful for my career. Okay, so let's see how this looks compared to the other 2016. So the magnitude here is a little higher. And it actually, here it's not actually perfectly monotonic. Here it's not perfectly monotonic either, but this problem is solved. Here from 4 to 5 it goes lower, from 6 to 7 it goes lower. Here it goes lower from 2 to 3, but not substantially. And otherwise each one's higher than the previous. Oh, what was the information coefficient for 2016? 0.036. So what was it here? So it's a little bit higher, not significantly higher. So the next one, 2017, I should get 0.05 is the floor I'm looking for. If I do better than 0.05, I'll be happy. Where are we at? 28, so close to done. Two more. 39.40. Hey, Hike, let me show you real quick. So the goal is to get something where I can just run a single line of Python code. It will output buys and sells for the day, and it should make money reliably. I want to beat the S&P 500 significantly, so do 3 to 4 times better than the S&P average. S&P average is 6% per year, so I want to get 18 to 24% per year and have it be market neutral. So it shouldn't matter if we're in a bull market or a bear market. The strategy should give this roughly the same returns regardless. So this is the outline for the strategy. So you don't want to use all stocks. You want to isolate some group of stocks that behave similarly. For instance, an ETF is going to have way different price movement than Apple, so you don't want to train those together. You also want to train high volume stocks so that your strategy is scalable and so that slippage is low. You don't want penny stocks. That's basically it. So I've isolated a stock universe. I wrote some code to do that. I have several different universes. I found one which performs really well. And then I'm training a returns model on that universe. So my model is predicting the Sharpe ratio over the next 5 days, but this should generally be able to predict anything like returns, probability of a positive return, return relative to market, return relative to sector, things like that. And then I have a good returns model. So the final step is to implement a portfolio model. Take the output of the returns model, and based on that, here's the capital allocation, basically. So the returns model I got about a month ago. And basically the reason I think it's good, I went over this before, so if you want more detail, you can go back to earlier in the screen. I have not made a document or this kind of things. I'm not sure what that means. But basically this I thought was working well because it's doing, I have the top metric, information coefficient is predictive power. The next four metrics highlighted in this red box are indicating the stability of the model. And I'm doing much better than my goals for all of the metrics. So that's the first reason it looks good. Furthermore, if I look at the decile analysis, this is exactly what I'm looking for. So it should be the lowest decile is the worst performing, which is what we see here. Top decile is the best performing, also what we see here. And then it should be monotonically increasing in between, which means each decile is higher than the previous decile. And all of that is exactly what we see here. So not only are the metrics really good, the decile analysis is really good. And finally, when I do a walk forward analysis, I'm hitting my information coefficient goal of 0.01 and annual information coefficient to information ratio goal of 0.3 every single year. So what help does it make for users? But for now, I have started to gather some data as well as system, which is work on model for now, and created data where I'm currently doing live testing. Good. So you're live testing a strategy. What's your strategy? Yeah, and so I've basically been tweaking the model a bit, tweaking the model and portfolio together. I've found what I think seem to be pretty good portfolio strategies and models, but no specific one stands out. So I'm going to test a bunch of them, a bunch of different models and portfolio strategies together, maybe about 100 models or so, 100 strategies altogether. And see what performs well over a month of paper trading. So yesterday or 2 days ago, I found out that the less validation data I use, the better. I still need some validation data, but if I'm only using 6 months to validate the data set, it performs a lot better. So let me pull this. So now I'm going through and I'm redoing the whole walk forward analysis with just 6 months of validation data to see how does it perform. And I'm going to compare this directly to the results I got with 2 years of validation data. So let's see. This one minus 0.06 to plus 0.06. So the magnitude is worse, significantly worse in 2017. Both are monotonic. This one, the decile analysis looks slightly better, but not significantly. 2018 minus 0.04 to plus 0.04. So 2018, though, does a lot better. The spread is like double. And it looks almost perfectly monotonic. Way more monotonic than 2 months. So here it should be, what, 2019? Oh. Now it should show me 2019. Wait, what am I doing here? '15, '16, '17, '18. But none of these are repeated. Yeah, so what is this? I'm not running anything anywhere else. No. Well, now it's doing 2018. What help does what make for users? So I'm using a physics as well as math. I'm not sure exactly what you're talking about there. So I need to figure this out and document this, but yeah. So that's it for today's stream. Thanks for watching. I've got to get to work. Have a good rest of your day. Thanks for watching. Adios. I'm not sure exactly what you're talking about there.